Today, the market sold, but it did it politely. The S&P gave back 0.33%. Its high printed at the opening bell, and then it was one long slide the rest of the day. A fourth straight afternoon under the record. And here is the twist. The fear gauge went down with it. This is the Algo Index market close for Tuesday, the 11th of August. That is the exact opposite of yesterday. Monday was a still index above a rising fear reading. Today the index fell and fear eased because the selling was not a scramble, it was orderly. And it walked straight to a support line the options market had already drawn before the opening bell. The line sat at 77.17. The slide stopped a quarter point above it. And underneath the calm, the largest negative dealer hedging reading in a month, $11 billion, was quietly absorbed at the 7,700 shelf, the session before the inflation number that erases the map. Here is the countdown of what today was really about. $11 billion of negative dealer hedging, the biggest reading of the month, and it was not a bet on direction. It was the professional money buying the cheapest protection of the year into the number. 2. The real 5-minute session, one clean one-way slide, and a pre-drawn line it stopped dead on. 1. The single name that walked its own priced levels to the tick. Then the desk card, and the map into Wednesday morning. Start with the board, and the quiet built into it. The S&P closed at 77.28, lower by 0.33%, with the NASDAQ 100 and the Dow both off about the same. A broad but shallow down day. The whole high-to-low span was 64 basis points, and the day's high printed right at the opening bell before the slide began. This was the fourth session running below the record at 77.93. Now the part that makes today the mirror image of Monday. The market fell, and the fear gauge fell with it, down about 1% to 15.25, with its companion future swings measure easing 2%. Falling price and falling fear together is the signature of orderly selling, not a rush for the exits. And the option prices say the same thing. 1 month implied volatility sits near the 13th percentile of its own year. And the cheapest index puts carry about 14%, the lowest of the year. The read from this board is calm, priced in selling into a number nobody wants to guess. Now the piece your screen never printed, and it is the whole story of the day. Our real-time read of dealer hedging finished $11 billion net negative, the largest negative reading of the past month, and it split roughly $6 billion of fresh put buying against $5 billion of call selling. Strip the jargon, and it says one thing. The professional money spent the day buying downside protection, not selling the market, orderly de-risking into tomorrow's number. And the positive gamma shelf around 7,700 absorbed almost all of that flow and held price up through the afternoon. 2 quieter tells point the same way. The shape of protection pricing has kinked, with this week's expiration getting more expensive while later weeks eased, which means the entire event premium now sits inside tomorrow's expiration. And the cheapest 1-month index puts trade near 14%, the lowest reading of the year. So defining your downside into the print is on sale. This is a market paying up only for the exact night it is afraid of, and nothing past it. So what actually pushed price lower? A little past midday, word crossed that the Strait of Hormuz will not reopen until Iran's conditions are met, and crude climbed to a 1-week high. Higher oil revives the inflation worry 1 day before the report. A Chicago Fed official called inflation the biggest problem facing the economy, and the 10-year yield touched a 1-week high near 4.75 before easing back to 4.68. Energy led the market up more than 1%, while the index slid, so this was rotation into oil, not a rush for the door. Give me a minute on the chart, because the 5-minute session was unusually one-directional. Price opened at 77.67, and that open was the high of the day. There was no morning grind higher today. The record ceiling at 77.93 turned it away for a fourth straight session before it even got going. From that opening high, it was one long, orderly slide. No flush, no single headline candle, just steady give back, all the way down to the day's low of 77.17.25, printed at 2:30 in the afternoon. And here is the tell worth keeping. That low stopped 1/4 point above the options implied support line at 77.17, a line drawn from last night's pricing before the bell. And it sat right on the 7,700 shelf, where dealer hedging buys the dip. Price was absorbed there, and lifted back to close at 77.28, just above the 77.20 inflection. The clean map into Wednesday is short. 77.56 is the reclaim that neutralizes the downside lean. 7,700 is the shelf beneath. 7,800 is the ceiling above where dealer gamma turns negative. And 77.93 is the record still standing between price and any breakout. The loudest options conviction of the day was not a call on direction at all. It was the de-risking itself. $11 billion of net negative dealer hedging, the largest reading of the past month, roughly $6 billion of it fresh put buying against $5 billion of call selling. On a day the index fell only 0.33%, the professional money was not shorting, it was buying the cheapest downside protection of the year and refusing to commit a cent to a guess before the number. There was one single name worth flagging, and it was a small mirror of the whole day. Tesla stayed firm on a weak session and obeyed its own dealer levels to the tick. Its lower gamma strike near 330, marking the low of its day, and its call resistance strike near 335, marking the high. The through line is worth saying out loud. When the most important number of the month is one sleep away, and an oil-driven inflation scare is fresh on the board, the fastest money does not press a direction. It buys insurance while insurance is cheap. The desk read the day for what it was and barely touched it. One trade, a dip long taken at the 7,700 shelf in the early afternoon, right where the dealer hedging buys the dip. Then the same real-time hedging read that we watch all day rolled over, and we stepped out at even before price ever confirmed the turn. The trade closed within a quarter tick of entry, a clean scratch, 0 won and 0 lost, and the book stayed flat into the close. Nothing forced, and no position carried into the most important number of the month. On a day when the right move was to define risk and wait, we defined risk, took the one look the shelf offered, and stood down the moment the flow told us to. A flat book into tomorrow morning is exactly where we want to be. Let me grade our own last call before I set up the next one, because we say these out loud. Monday from this seat, we said the market was coiled under the record into Wednesday's inflation print, with 7,700 the shelf to hold, 7,800 the ceiling, and a preference not to chase. Here is how that aged. Tuesday wound the coil one turn tighter and slid, but the 7,700 shelf held to the point. The low stopped exactly at the price support line, and the fear gauge actually eased. The hold the shelf, do not chase read aged well, and the decider is no longer days away, it is hours away. So the map. Tomorrow morning at 8:30 the consumer inflation report lands. The headline expected near 3.4%, and it is the release that redraws everything. Before it, an oil report and the weekly crude inventories cross early, and a large network equipment maker reports after tomorrow's close. Then, Thursday brings producer prices and jobless claims. But make no mistake, the 8:30 number is the one that matters. The two-sided setup is clean, reclaims 77.56, and the downside lean is gone. A friendly number with volatility sliding can run towards 7,800, and because dealer positioning turns negative above that ceiling, a clean break there can accelerate into a fast move rather than fade. Lose 76.80, and the whole constructive read comes off into a downside press. Anyone who tells you which way tonight is guessing. The one gift on offer is that the protection to trade that number with is still priced at the cheapest of the year. And there are no entries before 9:45, once the report has redrawn the map. 2 links and 1 room before I let you go. The Algo Index Trading Journal is open to anyone at no cost over at members.algoindex.com/off/signup. And every setup you log there is scored against the very price on your screen the moment you committed to it. How well these dealer levels actually behaved, held or gave way, stays out in the open at algoindex.com/tools/gamma level accuracy. Tonight's full written version is posted at algoindex.com/blog. And the traders who talk through every one of these calls in real time are gathered on Discord. Rest up, keep tomorrow's 8:30 inflation print circled, and I will be right back here tomorrow night.